well. But bottom line is, it signifies the same thing, that there was indecision as to which way the market is going to go for that time period. And again, for that time period, the market closes at or near its open. I consider that psychological aspect of the market, indecision. That's the key element. And it's not until we find a preceding candle activity, whether it's a higher close or a lower close of that range that the doji's established, that gives us a clue as to a shift in the momentum of the market. So the doji is forewarning us of potential changes coming. Now the doji has several different shapes, sizes, and names. As you see, we have a normal doji. We have what's called a gravestone doji, and this is one that you'll find as the market closes and opens closer to the low. The dragonfly, as the market closes and opens closer to the high. And of course, a long leg or rickshaw doji, as the market has an extraordinarily long range candle. It's kind of a difficult pattern to play because of the fact that it has such a long range. So we need to focus on the open and close, and also we need more information from prior time periods, in which we will show you. But these are the four basic elements of doji patterns. Now, dojis, the power behind them is this. They indicate indecision. They close where the market begins. Confidence is lost in an uptrend or in a downtrend. In a bullish or bearish trend, the last thing you want to see is indecision. I mean, you want to be, if you're long and the market's in an uptrend, you want to see decision by market participants who dominate, bulls who dominate the market. You want to see the market close, what, above the open? You want to see the close near the high? You want to see lots of green candles. That signifies that a bullish uptrend is strongly intact. All of a sudden, you start to see a doji, it starts to show indecision, and that's where you start to raise the caution flag. So dojis show rejection or failure of a momentum, and that's a significant sign that changes are coming. Now, doji top patterns are more reliable than doji bottoms, but personally, I find that the doji itself is the most reliable signal, and it's the preceding candle that follows the doji that really gives you the clue as to what's going on in the marketplace. One other observation is that I find that dojis form more often than not at pivot support and pivot resistance numbers. In fact, as we have already gone through an in-depth study of pivot point analysis in our first CD, the thing that you need to realize is that we use pivot point analysis to help us predict the actual range of the next time period. There's a large percentage of the time that the market itself, price will either hit the low or hit the high, and in a lot of times, the market will actually stay within the pivot point numbers in a given time period range on a day, week, or month. Now, the amazing thing is we find a lot of times the low of the day or the high of the day is actually, or a 24-hour session, is defined within a certain time period, is formed by a doji pattern. And we have some statistical studies to show you that. First off, let's talk about the doji and why it's important not to just rely on seeing a doji and following the rules or guidelines that others teach that say every time you see a doji it indicates a top, and every time you see a doji it indicates a bottom, because that's just not very good follow-through advice or research, number one. Number two, I think, like I stated, here's a doji, and notice that the market, the real bodies of these following candles stay contained within the range of the doji's high and the doji's low. Notice that? So we don't see a higher close of the doji high. We don't see a lower close until this candle. And again, that's a very bearish, ominous sign. In fact, this long red candle here, that's another one of my favorite candle patterns. It's called the Marabuzo, or it's called a breakdown or blast off, and some people call it a benchmark candle. We look for the midpoint of that to act as resistance in downtrends, and we look for the midpoint to act as support in uptrends. And we're going to go through the benchmark, but I thought I'd show that for you right here, even though we're not covering that in this slide. This slide is to help represent what we see with dojis and doji bottoms, and why they're not as reliable as doji tops. But friends, they're not reliable by themselves. That's the key point here. Now, in a strong uptrend, usually the market will close near the high as larger capitalized traders hold or add to positions. That's a key word, because a lot of really smart traders, they build a position. They don't just trade and then get into maybe 100 contracts. They build and add to that position. And so if they're trend following traders, they will continue to add until the market tells them to stop